Welcome, guys. It's another time where we'll be bringing you some business tips in terms of recording in accounting. All right. Today, we are just going to be going into um, recording basics, and later on, we'll now start coming with some practical explanation. Let's just go into the theory aspect. Quickly, I just want to share my slides quickly and see what we can do with this. All right. So quickly, I hope you can see my slide. Yeah. All right. Let's start. Okay, good. So importance of accounting concepts. So this is important, that what do we want to derive from having accounting principles? Number one is we want to derive that our records are accurate, right? The accuracy of our records. Number two is clarity, right? That our records has no ambiguity. It's clear and straight facts, And we also want to show that our records are consistent, Yes, the methods that we are going to be putting into recording of our record or transactions, they are consistent. And number four is to also prove to investors and business stakeholders that these records are trustworthy. Trust. All right. These are the importance of accounting principles. Let's take them one after the other. Right. Before I go further, now, when we talk about accounting principles, we can also use another name that's like it. We say it's accounting concepts, right? But when we say accounting concepts, it's just like fundamental ideas. But when we talk about accounting principles, these are the specific rules and regulations or guidelines of accounting. Let's take some of them. And number one that we're going to take today is called historical cost. And now historical cost is just the same way it sounds. It is when we recognize the original cost of our assets. When somebody, for example, you say you bought an asset and over the time you believe that the assets are deteriorated, it does not worth how much you bought. But in accounting, you will definitely start from the original cost of purchase. Now you reduce the depreciation, right? And it will not give you the net book value as at the time you are recording. That is historical cost. And for prudence and conservatism, we say a company should choose the most suitable accounting method. When, most times we project or we give a budget, right? So when you are given a budget, use that method that gives you the list. For example, profit. You want to project your profit. Don't start projecting 1 million, but you can project that, okay, we will start from 10,000, 20,000 realistically, you are being prudent about that. But when a million comes as a profit, fine. All right. Let's go to the next one. Materiality. Materiality is actually talking about how a business is different from another business in terms of size. What is 10,000 pounds to one company cannot be anything to another company. Some company will just put 10,000 as miscellaneous because you are making over 10 billion in a year. 10,000 is nothing to them. So what is material to one company is it's immaterial to another company or business. All right, good. Accrual or matching concept. Accrual means that you record, right, your revenue as at when you earn it. If you earned your revenue today, you made sales today, record it within that period, even though they have not been paid for. Okay, let me give you an example. Now you sold your product, maybe your product, you sold your product, and that product as of today has not been paid for. Don't wait until when it was paid. I mean, when it will be paid for. Record it as of today. And that means you will now have a debtor. And record it also in the debtor. So when they paid, yeah, the debtor will be reduced and the debtor will be reduced and your cash will receive. All right. So that's exactly what Accrual is talking. Is not what a cash basis. All right. Good. Let's go. Yeah, realization is just like also like Accurate concept. Okay, when you realize the money, So quickly, I'm just watching our time. Yeah, I don't want this video to be so long. Now we are coming to an understanding the accounting concept, and when we talk about accounting concept, we're talking about the fundamental ideas. Okay, let's start with one fundamental ideas in accounting: business entity. In business entity, we know that the owner is different from the company, to the extent that in law, the company can sue the owner, right? And the owner can sue the company. Huh? And we all know that the owner owns the company, right? But in business, they have different entity. We have two different entity, all right? So what we are trying to say here is that every expenses that you incur as the owner, let it be as the owner. That of the business must be separated from the owner's expenses. All right. So also the income. All right. Good. Money measurement is also part of the concept, right? In this case, it is things that can be measurable that we record, right? We do not record, let's say, climate change kind of stuff. I've never seen that. Okay, in reporting the climate, what this in this branch and the climate, what that, no. It's something that can be recorded that we must always put in our recording, right? In our records. All right, good. Going concern. Now, this talks about the balances that in when we are balancing our books, we should all have it in our consciousness to say we are going to be there tomorrow, right? We will continue. We will continue until when we decide that we want to dissolve the company or we want to liquidate the company by any other reasons, all right? But if that is not there, the way we have a closing balance, we must quickly have an opening balance, meaning that our operation continues on and on and on, going concern, going on and on. Right. So objectivity is the next one. This one is talking about that we have to have evidences of every of our records. We must have, how did we get this record, right? If we say sales is so much, how, right? Where are the invoices? We must have basis, right? There must be no what? Biasment. You should not say, I think, where is the basis? You have to keep records. And in keeping records now, we know that company records, some country says 5 years, you must keep the record. Some country says 6, 7 years, you must keep the record in case you are going to be asked. Okay, so record keeping is or filing is a very important thing. You must be objective. Okay. Right. Consistency is talking about the method at which you use. For example, in depreciation, you should not like use in the first year, you use straight line method. And all of a sudden, you just feel like, towards the end of the year, you want to use fixed method. Fixed method. No, 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 no. You must be consistent over time, maybe 2, 3 years, and see if this method is working for you or not before you decide with a normal way of changing your method. All right. Now, before we call it an end, we talk about uniformity. Uniformity is actually talking about how do you record, right? If you are in banking, for example, the way you record banking transaction is different from commercial business like that. Banking is different, and the way you record as an accountant or as a manager in government is different from the way you just record in just a liability company, So there must be a standard at which we record things. There must be uniformity. So I think that is just that for now, because I don't want us to take so much time here. When we meet later on, we will be talking about what? Practical examples of all this. We're going to be putting this into practice. See you next time. If you have any question, please do not hesitate. Drop me some questions. Drop if out of this, maybe you feel that you didn't hear me well, or you need more explanation. Please, I'm begging you, let me know. All right. Till we'll see again. Ciao, ciao. Bye.